I think there's a lack of understanding of how the market actually works, right? It's always forward looking. So
Right.
I like to tell the clients, what you're looking at right now is not what the market's reading. They don't care about what already happened today,
Yeah.
because what happened today was actually already factored in a month ago.
Correct.
So that's why we saw, I mean, a little bit of a dip, and obviously some data came out that made it a little weaker, that made the rates drop a little bit, and then we had a really small blip. And if you missed that blip and thought this is the moment that rates are going to shoot down lower, you were extremely wrong, because obviously everything just started going up the other way.
Alrighty, folks, there is a lot of stuff going on in the mortgage market. And like we always do on Thursday, we talk with Convoy Home Loans and we bring you the truth, even when you don't want to hear it. We got to bring you the truth. Last week, in a very private school session, you shared with us that one of the largest Wall Street buyers of DSCR loans has stopped buying. So we'll get a little update on that. We also obviously had the Fed meeting yesterday where they cut rates and rates went up again, and not by a little bit. Rates went up a lot. Now we have people like Franklin Templeton and T. Rowe Price talking about 5 and 6% 10-year notes. Folks, stop waiting. Stop waiting. Write deals that make sense today, that have 30-year fixed rate today, because things might get scary in 2025. Jonathan, what say you? What's going on? Where do you want to start?
I mean, I'd probably start with that conversation about not waiting. The market, and we've had so many conversations with clients that are honestly confused. And I think that the over in my career, I have not seen as many people like worried about and so engaged in where the market is than in this market right now in the last 3 years. And I think that the reason being is social media, all these influencers coming out talking about rates. And a lot of these people are following these influencers. But what they don't realize is a lot of these influencers, some of them are not doing that many deals, or are not doing, like, their job is influencing, right? So because of that, um, I think some people are getting advice from the wrong people. Some people were waiting for, obviously, if you go back in our videos, like a year before, they were like, rates are dropping to 4, rates are dropping to 3 immediately. Other people said as soon as Trump hits the market, rates are going to drop and shoot down to 2. All of this stuff is from the social media influence sphere, and people like me and you are literally out here digging back the road to sanity and trying to get these people to walk it, because
Yeah.
what they are hearing is not really what the market is providing, right? And I think that the biggest confusion
Yeah.
is, why are rates going up when the Federal Reserve is cutting rates now, right?
Yeah, well, let's just have that conversation again. We've talked about this so much. We've warned people not to believe the hype that rates were going lower. In fact, we've talked about, if you like it, lock it, for the better part of a year now. So I feel good about what we've done. Unfortunately, a lot of people listen to people that are just, fake influencers, right? They don't actually do this business. They don't watch the market. So, short answer is I feel good about it. But what's happening? The last 3 times, including yesterday, the Fed lowered rates. There's 2 things I think people need to realize. One, the market already priced in the cut. The cut was priced in. What wasn't priced in was the Fed's hawkish, very hawkish stance about 25 and 26. What does that mean? The Fed had told us in September they were going to cut 4 times. Now they're going to cut 2. In fact, there is one Fed president who says 0 cuts in 2025. I do want to put this on record. I said that about 6 or 8 weeks ago, that there will be no cuts, long before the Fed thing came out. I really think that's possible. No rate cuts. So that just takes the entire long end and reprices it. We've seen the 10-year note go up about 25 basis points in 2 days, which is going to rip more. We saw mortgage rates at 6.8 like a week ago. They're at like 7.2 today. So, folks, the Fed does not control mortgage rates. Stop thinking it does.
Yeah, 100%. And I mean, I've been telling clients this too. We already broke past basically where we were in July.
Yep.
Um, we are now headed to where we were back in October.
Oh gosh.
And that's October of 23. And I think the scariest part about this is the fact that people are thinking that I think there's a lack of understanding of how the market actually works, right? It's always forward looking.
Right.
So I like to tell the clients, what you're looking at right now is not what the market's reading. They don't care about what already happened
Yeah.
today, because what happened today was actually already factored in a month ago.
Correct.
So that's why we saw, I mean, a little bit of a dip, and obviously some data came out that made it a little weaker, that made the rates drop a little bit, and then we had a really small blip. And if you missed that blip and thought this is the moment that rates are going to shoot down lower, you were extremely wrong, because obviously everything just started going up the other way. And everyone thinks, I think for some reason, that um, Trump will be the savior of the market, which I think that people should take away that notion, and not look to someone to
That's
save
the
the
key.
market.
Yes, that's the key. Can we
Yeah.
stop looking for some magic pill to change the market? Folks,
Yep.
write a deal that makes sense today. One of the most disastrous things that I heard over the last 6 months from some of these crazy influencers was marry the house, date the rate. Do you know how many people got into alligators, negative cash flow property, because they thought they would magically refi at 5%? Folks, that's not coming, right? You bought a bad deal. Shame on you.
Yeah, and I mean that was also because the expectation of people are just, it's skewed, right? And they think that the speed of how things will move down is going to be consistent with how it went up.
Right.
And unfortunately, the way it works, it unfortunately works inversely like a GPA. If you think back to school, it's so easy to get your GPA down, but it's so hard to get it up. Like this is the same
Jonathan, I
scenario we're
wouldn't know
right now.
anything about that, but I'll trust you.
but but yeah, so I had an interesting obviously conversation with a lot of clients in regards to the current market. I've locked in a lot of people prior to, and clients are coming back and saying, hey, I actually had a client come back, write an email to me last night and said, hey, um, the market is obviously very, very shaky, and I think that despite my rates being lower right now, I think that I really need to take advantage of what's on the table versus what I hope might come in a year or two.
Yes.
Because and I told him, hey, look, this is right now is probably the best opportunity, and we've been saying this for the last 5 years. Like, it's the best opportunity to be able to try to invest in real estate, to write good deals, right? Do the work to write amazing deals. Like when people are panicking and people are worried and they're sitting and waiting, right? This is like the best time for you to write the aggressive deals to make the
Yes.
deals happen. So if you want
Couldn't
to
agree
do
more.
that, it's better to have liquidity and everything ready to go for you to be able to make the moves, instead of waiting for, oh, let me just wait until the rates drop an eighth or a quarter or a half. Because once you're doing that, you're trying to time the market.
Yeah.
And the greatest investor of our time, Warren Buffett, even is like, it don't it's not time, you can't time the market, period.
Yeah.
It
Time
doesn't
in the
happen
market.
that way.
Yeah.
Yeah.
Time. Yeah. Well, let's talk about something that you were gracious enough to bring to the school community at One Rental at a Time last week. We'll do it here for the masses on YouTube now. There was a very large DSCR lender who essentially said, "I'm full, I'm out." There was theory that they might come back in January, but it looks like there's some rumblings that they just might be out entirely. Is that right?
Yeah, and it's probably the biggest Wall Street buyer on the market, and they are basically turning off all faucets,
Wow.
and they left a bunch of these lenders that were selling to them directly, with bags that with them walking with nothing in their hands and everyone's just left holding the bag. And the biggest problem with that is, and I'm seeing that unfortunately, because a lot of people like in the general community deal with kind of the I don't want to call them minions, but they deal with the minions of the entities, right? So they
Right.
deal with the people that don't really know what's going on the higher scale, higher level, and
Mhm.
these loan officers will tell them, no, we can do this loan with like rate card that doesn't exist. We can do
Wow.
this loan with terms that don't exist, right? And it's because the speed of how they're moving and the information that they're getting is insanely slow compared to what we're talking about right now.
Right. Yeah.
So now what we're gonna see in the market is all of these lenders that were DSCR lenders that were selling DSCR loans to the actual investor, they are now gonna have to sell all these loans on pennies on the dollar, right? 50
Well,
cents on the dollar.
yeah, let's break this down because again, and you shared this last week. This large buyer, they had entire organizations where somewhere between 90 and 100% of their loans were just feeding this Wall Street firm. Now, these
Correct.
folks were out there closing loans all the time, and they just said they're full. So now they have this loan product that they thought they were going to get, X amount of dollars for. They're now going to get X minus, and let's be clear, lose money.
Yeah, and honestly, I don't know how much longer these guys will, like lenders in general, will fund these loans
Oh, it's going to
because
stop. It'll
yeah,
stop.
because if like anyone that was 100% reliant on these or 90% reliant on these this Wall Street fund, they cannot fund the deal
Nope,
because if
they're
they
out.
fund the deal, they would rather like lose the business than take a hit on actual money.
Yeah.
So we're going to start seeing the same wave of things happen that we saw in 2020, 2021, 2022, right? We didn't see it in 23 as much, didn't see it in 24 as much, but now we're going to see it again
Oh yeah.
where if the product comes back, it's going to come back with a higher spread, higher margin, and it's unfortunately for everyone that waited, right? Because now DSCR has become almost almost a conventional product. Everyone talks
Correct.
about it as if it's conventional now, right? Um, Now that is going to be a very, very hard product potentially to get, and it's going to be extremely limited because buyers are leaving.
Yeah, no, we talked about this last week. The outcome of this is really clear. For seemingly 8, maybe 12 weeks, you and I were talking almost every week saying, Michael, I can't believe it. DSCR loans are about the same rate as conventional, same rate, same rate. Guess what's going to happen? If if this comes back, we're going to see a point and a half. We're going to see lower LTVs because there's, my opinion, these are my words, not yours. The only reason the Wall Street firm shut the door or stopped buying is they were losing money. Wall Street is a greedy money printing machine. And if it works, they'll keep doing it. But if they lose money because of bad risk management, low values, whatever, they're going to stop doing it just as fast. So, as I said last week, and I'll say again this week, I think they realized, 2 or 3 years into this loan product that they were being too aggressive and it bit them in the ass. That's what happened, my opinion.
Yeah, yeah, absolutely. And obviously for us, we write a lot of DSCR debt
Yep.
on top of the everything else we do. A lot of our money has moved away from Wall Street and into the normal back again to the insurance carriers and smaller hedge funds and smaller funds that are trying to step in to fill our pool because we just
Mhm.
have specific pools that they sell off of our loans. And that's kind of what's coming back again and filtering through. And actually, those rates are obviously all the rates are up, right?
Yes.
But I checked this morning, and even with the adjustments, like DSCR versus conventional on investment properties is literally still only maybe an eighth or a quarter off.
Okay.
So if conventional call it is 7.25, like you said, 7.3, 7.5, whatever it ends up being, like DSCR will be 7.5, 7.7. Like it's still
Yeah.
in the realm, right?
Okay.
But what this is interesting is it's going back to what you were kind of talking about off camera and kind of in the videos. Rates, I mean, we're back in the upper echelon of the sevens heading into
Yeah.
the eight. Like the market is starting to adjust to that position again. And I think this is, I think, I don't know, you could say your opinion, but I think this is an amazing time to get aggressive in the market just because there is so much fear on the streets that I'm seeing right now that like you can write amazing deals right now. That's my personal opinion.
Yeah. The only person that wins in 2025, and I said it today on the Daily Financial News Live, is investors. The only people that are going to win in 25 are buying investors, the folks that write disrespectful offers. They follow up multiple times. They write deals that cash flow day one at 7.5 or shoot 8%. The only people that are going to win in 25 are investors. What does that mean? Very low transactions, not a lot of price discovery. There's going to be a bunch of pain in the multifamily space. It's going to get ugly in the syndication space. And it's going to be really tough for first-time home buyers. First-time home buyers are traditionally 40% of the market. Today, they're 24 and probably going lower. It's going to be another hard year. I told people 2025 would be harder than 2024. When I said it, people didn't agree with me. Maybe now they're going to agree with me. But again, to your point, the only people that thrive in 25 are real estate investors who do the work, follow up, write disrespectful offers, and finance with 30-year fixed rate debt that cash flows day one. You're going to win. You're going to kill it. Everybody else is going to be a struggle.
I think that's an amazing point to say. And now I think if you can grab something with a six handle, on the rate side, I think it's a win. I think it's a major win. I think people need to stop looking for the fives. People need to stop looking for someone to save the market, right? Because the only person that anyone cares about, like that person doesn't care about anybody else. Like these saviors don't care about anyone else except for realistically themselves, right?
Yeah.
So it's up to us to kind of do the work, write the disrespectful offers, write the good deals. If you can get a six handle, I'd say if you can get a six handle today, it's win. And hold on to that loan, 30-year fixed, make it long term, make sure all your planning is 5 years, 10 years, not like 6 months, 12 months. Don't take bridge loans at 6 months hoping that appreciation will happen. Because that's what I'm seeing a lot too, is these clients are coming in a month before their bridge loans are up and they're trying to refinance out and they haven't made a payment
Ouch.
since the beginning because everything's deferred in and the appraisal doesn't come in as high as needed. And now you're looking at literally the worst possible thing, which is now you are paying more money. You've paid money to fix the property. You pay money to buy the property, and then now you're going to pay more money to try
Cash
to
in,
save the
cash in
property.
refi. Yeah.
So I think there's a lot of risk right now to these shorter term loans. So I would
Absolutely.
never recommend to any client that you take less than 12 months. If you're taking a bridge loan, it better be less than 12 months. And on top of that, it better be like a built-in margin of at least 20 to 40% so that if you ever have to fire sell it on the market, you can do it without losing money, right? Because
Yeah.
that's the worst thing you want to do.
Yeah, no. At the end of the day, folks, if you're in my community, writing deals today have to be with 30-year fixed rate debt. If you're a developer or you're doing BRRRRs or whatever, I get it. But yeah, the longer the term, the better your chances, in my opinion. If somebody wanted to reach out to Convoy and see what's what and what's right for them, how do they do that?
Go to convoyhomeloans.com and let us know you come from ORaaT.
Yep, there's a little drop down window. Just say one rental at a time. You will get this fine gentleman or his partner, Dustin. Otherwise, I don't know where you go, but you don't get the two rock stars. Thanks, buddy.
Thank you.
Mm-hmm.